In today's video, I'll be doing an in-depth analysis of Nike stock. The symbol is NKE, and for those of you who don't know what Nike is, they are the largest apparel seller in the world. Shares of Nike stock have been going down since late 2015, and I think that this creates a good buying opportunity in a very, very solid company. So just a little overview, Nike has a $87 billion market cap, a price to earnings of 21, and a dividend of 1.4%. So a dividend of 1.4% is pretty low, but it's actually a good thing to see in a company like Nike because it means that they will still be paying you a little bit of money that you can use for dividend reinvestment and things like that. But they will also retain a large amount of their earnings to reinvest into the company and continue to generate future growth. Another great thing about Nike is that they are a very iconic company. Pretty much everyone knows what Nike is. Forbes ranks them as the number 16 most valuable brand, and that's the number one of all apparel companies. So they are definitely a company with good name recognition, good customer loyalty, and all in all, just a great company. So a price to earnings of 21 is pretty high, and as a value investor myself, I do struggle to pay a higher valuation, but on a company like Nike, which is a really, really solid company that I think is definitely going to continue growing, I think that paying a premium is justified. I will also go into why they are a well-managed company that is generating very, very strong amounts of cash, and I will go over some future catalysts for their growth that do justify this price to earnings. As you can see, it is also a discounted price to earnings to their 10-year average, which is about 30, as well as a discount to their price to earnings over the last 5 years. Nike also has a very low debt, which means that interest payments and paying down debt will not stifle future growth. As you can see, their free cash flow to long-term or over long-term debt is 159%, which means that their free cash flow more than covers their long-term debt. This means that debt is really not going to have very much of an effect at all on Nike, so that means that they'll be able to grow more quickly than a company that was weighed down by large amounts of debt. Nike has also consistently grown revenue at over 4%, and for the last 4 years, over 5%. They have also grown their EBITDA by about 8% per year over the last 4 years, which is great to see as well. The company also has a very high return on invested capital, which is important. This is just a measure of what the returns are on the money that they invest into their own company. And as you can see right now, it is at 24%, which is very, very high. So that is showing that the management is using their capital very efficiently, which is always good to see in a company. As you can see, Nike also has a very high return on assets and return on equity, which means that the management is using their equity and assets very efficiently as well, which is good to see. All in all, Nike is just a very efficient company, and it is managed very well, which, like I said, justifies paying a slight premium on the price to earnings. So like I said, 21 is higher than I would like to see, but with a company that I think has great future growth prospects and is generating strong amounts of cash, I think it is worth paying that premium. There is currently a very strong movement for people to be healthier, and this will definitely benefit Nike in the United States. Very, very many people are starting to exercise more and just live a healthier lifestyle. This means that they will likely be playing sports with Nike equipment, wearing Nike clothing while they exercise, or buying Nike shoes. So this will all be great for Nike. And an especially large growth opportunity is China has begun to push sports as a means for them to grow their GDP. So this is going to be very beneficial for Nike because as people in China start playing sports and become more active, they will start using Nike products more, and this will generate more revenue and then more earnings for Nike. So recently, Foot Locker and other sports retailers have been struggling, and this has brought Nike down because they're selling Nike products. And this is thought of as something that is going to be hurtful to Nike in the future, but I really don't think that it is going to have as big of an effect as many people think, because people are still going to buy a pair of Nike shoes, whether they're buying it from a retailer, from Amazon, or from wherever. If I go and I want to buy a pair of Nike shoes or a Nike athletic shirt or something, I'm going to buy it because I want to use the Nike product. And whether or not there's a retailer selling it to me, or I'm buying it online, or I'm buying it directly from Nike, doesn't really matter, because the main thing that I want to do is buy a Nike product. And so where I'm getting that really doesn't matter. And so I really don't think that if Foot Locker struggles, it's going to have a massive effect on Nike in the long term. So in conclusion, I think that Nike is a well-run company that has very, very strong future growth prospects that will generate higher revenue and higher earnings for them over the coming years. They have pulled back and have been going down since late 2015, which creates an attractive buying opportunity. I am long Nike, and I think that it is definitely worth looking into Nike to see if you should add it to your portfolio. So thank you for watching. Please remember to like and subscribe.